Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup for the trading week ending April 12th, 2024. I'm Preston Brent. Thanks for tuning in. Well, the theme this week is really simple. The bears catch the bulls in an uppercut. Uppercuts are always deadly for those of you that box or like to box or understand boxing because it's always a surprise punch. Okay. By that, I mean inflation. So let's go take a look at what happened this past week. Just kind of see where everything is. Obviously, everything was in the red weekly. You can see weekly sector performance. Everybody's in the red. Year to date, we actually saw the Russell small cap move into the red. S&P and NASDAQ are holding in the green nicely. Dow is barely hanging on. But we were treated this week, as I said, combination of reasons. One, we've got conflict fears in the Middle East. Okay. We've got fears of persistent inflation pressures. That's pushing Treasury yields higher. And we got the US dollar moving up really strong, which typically viewed as a safe haven in times of international turmoil. We also saw the VIX, which it spiked to its highest level we've seen since last November, intraday. I'll show you that in a minute as well. But you can see the trailing ratio, PE, is at 23.17, but the forward's 21.25. So they reduced the PE ratio on a go-forward basis for 12 months by 8.3%. The dividend yield for the S&P is at 139, 10-year Treasury's 4.52. So you've got a big differential between the 10-year Treasury at 4.52%, closing out this week, versus the dividend yield. And 10-year Treasury is considered a risk-free investment. So if you look at the earnings yield at 4.74, you're only getting about 22 basis points more for a random investment across the S&P. And for that extra 22 basis points, it's almost like, is it worth it when you get a risk-free investment, right? So you've got a lot of big money moving into 10-year Treasury and to Treasury markets. So that kind of helps push down the PE ratios as well as the monies invested in U.S. equities. All right, current VIX, last week it was up over 22%. This week it was up 16%. So you can see up to 17.31. So it moved up almost 8% this week as well. Intraday, it was actually almost got slightly under 20. But we closed out Friday at 17.31. And you can see the weekly sector performance, even the best. Everybody's in the red for the week. Technology was the best at 50 basis points underwater. Financials were the worst. We have banks coming in on Friday. We had Wells Fargo, Citi, and JP Morgan, the mother of all financial institutions. And while they blew out their top line and bottom line earnings, their forward guidance came in weaker, especially their net interest income. And because, remember what I said before the earnings season, they're going to be paying really close attention to where our forward earnings, right? Is interest rates going to affect them or not? And you would think with higher rates it would help the banks, but in this particular case it didn't. And JP Morgan sold off big time, and that really set the markets to a tither on Friday, right? Really ugly day. And that's kind of what we saw. Annual sector performance, you can see energy's up strong, 15.59. Real estate bringing up the rear with a higher for longer interest rate because of inflation. You know, that was the primary factor weighing on the markets, the sentiment Wednesday when we got CPI coming out. It showed headline prices rising, pricing rising by 36 basis points, right? Overall inflation came in at like 3.5%. Core was up as well. Producer price, PPI, came in the next day at 20 basis points, so just a tick below. So that kind of calmed the markets just a little bit. But what it did was it reduced the odds of a rate cut in June. May was already out of the question, May 1st, when the Feds meet. June's going to be a very important meeting because That is when we get the dot plot for the second half of this year and the first half of next year. Remember, the dot plot called for 3 rate hikes. I'm sorry, 3 rate cuts for the year. All right, that was in March. So where is it going to come in this June? It's going to be very volatile. In fact, the market's priced in now just slightly over a 20% chance of a rate cut in June. It used to be like 85 or 90% just a few months ago. So markets are pushing out in time when that first rate cut is going to appear, and that's doing a number on valuations, which in turn does a number on equity prices. Okay. So that's kind of what we're seeing there. And then, of course, if we go over across the pond and take a look at the European markets, everybody was in the red there. The Euro stocks, FTSE, CAC 40, DAX, all in the red. Year to date, they're still in the green. The Euro stocks, which are the 50 largest companies across Europe, doing solid in the green in Europe. Now, the ECB, they left their deposit rate at their record high of 4%, but they may be uncoupling from the Feds. And they pretty much all in out announced that in June they were going to increase in confidence that they were going to cut the rates, right? They said it'd be appropriate to reduce the current level of monetary policy restriction in the month of June. So, that kind of prevented the markets moving lower, going much lower than they would have. And in the UK, we saw GDP expanding 10 basis points in 1 month, and over a 3-year period, just slightly more than that. And we saw Germany, their industrial production rose in February, 2.1%. So that's the second consecutive month of gains in Germany. Remember, Germany is the strongest country that make up the European Union. So when they do good, others tend to follow. Germany kind of leads the way, right? So we're seeing some of that out there. But if you look at it year over year, it's still down to flat to down just a little bit. So Europe is still not out of the woods yet, but doing just a little bit better, a little bit of consolidation there. And of course, if we go over the Asian markets, Japan, the yen there weakened, and it's in that 151, 152 range where the Bank of Japan typically has come out in the past and bought yen and sold dollars. And as a reminder, they recently ended their negative interest rate policy and unwound their yield control program. But just note that the country of Japan's monetary policy is one of the most accommodative in the world. Okay. And their expectations are going to maintain that for the time being. So that combination of a very weak yen and stimulus or accommodative monetary policy really provides a strong backdrop for stock market prices in Japan. And look at it. They're up 1.47% this week, year to date, 18.24. Now, I remind you that Japan's been in a stagflationary environment for over 20 years. So they're just now taking out highs that they made back in their markets, the Nikkei, decades ago. So they're just now coming out of it. And speculation is the Nikkei could be a good place to put some money right now. But that's kind of what's going on over there in Japan. Meanwhile, in China, they had a red week. We got their exports and imports. They fell in March. It kind of reversed some of the gains we saw in January, February of this year. Their exports shrank worse than expected, 7.5% in March, right? Their imports dipped 1.9%. They have a 3.5% growth the prior couple of months. So the consumer there in China is still hurting. I think China is going to be hard pressed to hit their 5% GDP growth this year. What that means, though, is China is going to probably have to put more stimulus into that economy. So that may bump their economy or their stock prices a little bit. You and I don't care. We can't really invest in the markets there unless you have 100 billion and pass a bunch of stringent tests. Can U.S. investment firms do anything over in China? But it's just not interesting to me. But it does affect global economy and their imports and exports and what they do. So that's kind of what I'm seeing right there on that. If what I'm going to do, let me just shift over here for a minute and show you a couple of key U.S. indexes, and you can just get an idea where the markets are flowing right now. We're going to look at the E-mini S&P 500 futures first. Take about 10 seconds to come up on your screen. And what you're going to see is an upsloping channel. I've been showing it to my members all year long, and I said, wait for the channel to break. And when it breaks, that's going to be the sign to start either picking up shorts or taking profits out of your trade, because you can't guesstimate. Everybody's been talking all year long. When is a pullback going to happen? When's a pullback going to happen? I've been telling our members, just wait, be patient. We need to see a clean break of this upsloping channel and probably a retest. And that's exactly what happened. If I blow this up, let me just get this set here so I can blow it up a little bit more for you guys, so you can see a little bit better. If I blow it up, you can see this break right here. We closed on it, and then we went right back. We tried to get back inside the channel. We did, and we came down low here. We took out that first initial intraday break, so that told me we're going lower. And my first target was down to 41.70, and we kind of hung around there for a while. If I move out here, you can see this. I'm sorry, 51.74 in the E-mini futures. You can see how it's been really good support, okay? And then all the way over here, we finally closed slightly below it. We almost came down and kissed the 50 EMA. As I'm telling our members, if we do get a little bit of a momentum reversal and a little bit of a move up higher, be very careful of any move higher. I still think we've got a little bit further ways to go to the downside. I'm looking at 5,000 as a really good solid support area, and that's only about 5% roughly from the all-time highs we made on April 1st, right? We were up 10.82%. And in the scheme of things, we're really not down that much, right? I mean, if I just kind of back of the napkin look at this and just kind of see where we are, we're only down about a little over 3%. That's one very ugly day in the SPX, right? So I think we're probably going to be 5 to 7% down. I've got targets on here anywhere from 51.27, which is slightly below the 50 EMA, down to 50.35, so I'm calling it 5,000. Now, I've seen other targets taking us down to 4,800, which still we could get down there and it would be a normal pullback. 48.21 exact would give us a fib node of about 38% off the highs. So I do believe we can come all the way down there and still be in a buy the dip, but we're not done with this dip yet, right? That's kind of what I'm seeing here on the E-minis. If we look at the Dow, you can see the Dow futures, again, it tested the 50 EMA and then finally broke it, did a retest and came down. We're just barely in the red or green this year. I do believe we're going to move into the red for the Dow over the course of the next week and a half as we round out April and May. I told you guys that April and May is just what I see is just a risky time for the markets. It traditionally has been. And I think you got some selling, people taking some profits because the tax bill here in the U.S. markets is due April 15th. I think I read a report where there's going to be a larger percentage of people asking for an extension because a lot of people got hit with higher tax bills, so they're probably going to extend. I think it was like 14 or 15% would ask for an extension on average, and I think this year it's almost just slightly under 20% are asking for an extension. So that tells me that there's people probably selling also for tax purposes. So that's kind of what I'm seeing for this. Now, I will show you the Russell. The Russell actually moved into the red for the year, right? Here we are right here. We broke this upsloping channel. It's also where the 50 EMA was hanging out, and we closed in the red, okay? I mean, the Russell is in the red about 1.15% roughly for the year. And the last time we were in the red and the Russell was right around February, towards the end of February, right? So that's not a good sign. So this is a pullback that I do believe has got some more legs to it. That could probably go anywhere from 4 to 7% is what I've said. Anything more than 7 or 8% will surprise me. But, you know, the markets are really good at surprising traders. So I'm just prepared for it to go down to the 5,000, and then we'll take a look and just see where volatility is, okay, and how this thing shapes up. Now, if we do look at NASDAQ has already moved down a pretty good little bit, right? It broke the channel all the way back over here at the first part of April. And you can see NASDAQ, it's not that far off the highs. And it's just slightly above the 50 EMA. Okay, so Nasdaq's holding up a little bit better, but it shouldn't surprise me because these were the stocks that led the way anyway. And if we look at the FANG index, you wouldn't even know we pull back, right? Here's the FANG index. We pulled back just a little bit, but we actually made new highs in the FANG on Thursday. And then just a slight pullback here, right? And the FANG was Microsoft, Meta, Apple, Google, Amazon, right? So you can see here that it's holding up a little bit better than forecast. I was expecting the FANGs to come down and test this area again, right? But the FANGs are holding up very nicely right now. But it's such a small sliver of the market that accounts for such a large index weighting value of the S&P. Now, if we were to look at the equal weight, or just take a look at the equal weight for a minute, you can see here in the equal weight, it also broke the 50 EMA, okay? And it's coming down. So this is showing that a lot of stocks were punished this past week. It's not down that much, but I do expect more downside, okay? And if we come down and look at volatility, this I've been showing this all year long. I said, look at the regression channel here. Vol really going all the way back to the middle of December of last year has been slowly going higher. It's been a stealth mode. And then it finally broke out here on Friday. You can see the intraday was around 1925 and it closed down here. It's very common when you get these real high, fast moves up. And then as we end up closing out the day, it pulls back a little bit, right? We're in my yellow zone, which is very choppy markets. You know, generally, these are just for other things for my members. But you can see here that the zone falls approximately greater than 15, less than 22 on average, right, for a yellow zone. Now, if I were to back this out just a little bit, you can see the last time we were up, when we really had a spike, was the end of October of last year when we made our lows, okay? And even then, we didn't get up much more than about 22, 23, right, when we made these lows here. So I'm not expecting that. If we do have that 5 to 7% pullback, it depends on how we get there. If we get there steady as she goes, it's going to move higher, but it's not going to be these big intraday spikes, okay? So that's a little bit about what I see here. Now, if we look at the back month volatility skew, I'm using the back month because the front month expires this coming week. So if we look at the back month, you can see we did move into the red, but intraday we closed back into the green again. This covers this April and May. It compares the April and May vol skew, and you can see here we're back in a normalized contango environment. And then if we go out to the 2-8 spread, which is May and September, which is another common one that I like to follow, a lot of other traders follow as well that understand volatility. We're looking at the May, September volatility skew. We're well ensconced in the green. So unless we have something unexpected happen, and if we get the expected that happens, then I think we'll stay in contango going out towards the end of the year. If we have the unexpected happen, and believe me, with all the geopolitical risk out there, we could see that, then we're going to see this move into the red. And then I think we'll see vol go back up into the mid 20s, possibly even low 30s if we get some really craziness out there. Okay. So remember, we got the Fed's meeting in a few weeks. We got earnings coming out. We're going into the first 2 weeks of earnings starting this past Friday. About 70% of the companies are going to be banking, all right? And if Citi, JP Morgan, and Wells Fargo were in the indication, then it doesn't look good for some of the banks, right? We got Bank of America, Bank of New York, Morgan Stanley, PNC, US Bank Corp, right? Blackstone, American Express, all these coming out this week. And then the following week we start to get some of the big mega cap tech companies and others. So this could be another volatile week depending on how those things go, and that's kind of holding the market up a little bit. Okay, if we look at treasuries, if we look at the 10-year interest rate here, you can see it almost near the highs. It closed down just a little bit on Friday, but it's up over that mythical 4.5%, right? And if we look at the 10-year bonds going out in time, looking at the 10-year bonds, we made a low on Thursday, Friday, right? Down 7.65. Now let me show you the 10-year notes. If we look at the 10-year notes, okay, 10-year notes intraday down 4.23%. So they're down about 4.1%. So if you're holding a 10-year note, the note itself is down 4.2%, 4.1%, yet the 10-year interest rate is up about 4.5%. So you're almost net flat even, right? You're not going anywhere. You have to hold that thing until it expires. If you were to try and dump it or roll it, you're going to just come out flat in the market, right? So it's not that good right now. Most of the people investing in what I've recommended to my members is go out short term, short duration, anywhere less than a couple of years. 6 months to a year is really good for now. When we start to see interest rates starting to come down, then you can roll out to 10-year, maybe a little bit longer. But now I would keep it there if I was doing this, right? And then, of course, if we come down and look at currencies, look at the U.S. dollar. U.S. dollar is made new highs on Friday, right? Up 4.79%. There is the opening price of the U.S. dollar. It's just been on a tear. That's fooled everybody, right? Most people thought the dollar was going to go down and Europe would be the currency to watch. Now, granted, we're not quite halfway through the year yet, but so far the dollar is shining and the euro is not. And speaking of the euro, if we take a look at it, you can see here the euro is hitting 2024 lows, right? We're coming down. We're going to get the death cross, the 50 below the 200 here. So this is something to be watched. Now they're going to cut the rates, so that's going to over in Europe. They may cut them in June, is what they're kind of forecasting. And as long as the Feds keep their rates higher for longer, you're going to see this go even lower, and you're going to see the dollar get even stronger against the euro, right? So let's just watch that. And then, of course, if we look at the yen, folks, I'm all over this one. I want to be long the yen. It's hitting my target right here, right? It's a perfect 3, 4, 5. So I do believe the yen is going to go higher, but you got to be willing to hold this for a while because the Bank of Japan is being very stubborn. They don't want to go out there and buy the yen and sell the dollar just yet because that'll upset some of the currency market, which will roll over into the Treasury markets globally. But I do believe that will eventually happen if the yen stays down in this area. So the risk of a bigger move in the yen is upside, not downside. Okay. So that's a little bit about what I'm saying there. Let's look at gold. Gold's been one of the rising stars, right? There's two stars in the market. One of them is gold. You can see gold hit an intraday high on Friday, up 18.2% intraday, closed towards the low. So that tells me gold is probably going to back off a little bit, maybe 100 points or so over the next week or so. There is no divergence in the MACD. I've told our members, that any dip down to this level here, I would be a buyer if gold comes down around the 2200 level, 2250 below, right in that area, maybe up to 2200. That would be a nice buy point for gold, but I would not chase it up here. Okay. And silver's the same. If we take a look at silver, it hit new highs, intraday highs on Friday, up 24%. I can see a little bit of a pullback in silver. No divergences there either. So I do believe any dip in silver should also be bought. And the people buying gold are not people. They're sovereign wealth funds. They're banks. Geopolitical risk. Typically, gold goes down when the dollar is going up. But this tells me there's some heavy, big buyers of gold, given what's going on around the world right now. So that does not last. And we're going to probably see, after another week or 2 or 3 weeks of gold holding up, pulling back. So I would not chase gold at this level. That's just me. And look at copper. Copper is also strong. Now, China's not building right now. They're hurting. So what's driving copper up? Commodity prices tend to be the last bull in the China shop before markets roll over, right? So I don't know if, and the commodity prices all across the planet are up strong, right? That's keeping inflation up higher for longer as well. And this is copper, right? Normally copper gives you an indication of the global economy, but in this particular case, it is not. It's one of those rare instances that I don't believe it's showing strength in the underlying global economy. In fact, the IMF came out and said the global economy, if anything, is going to back off a little bit over the next 2 or 3 years. And then, of course, the other rising star, or the leader in the pack right now, is oil, right? If we look at oil, it's up 22.85%. It's outpacing gold. Strong. There are a lot of geopolitical reasons why oil is up this high. It will keep inflation up higher for longer. Remember the Fed's preferred gauge, the PCE? It's core, but they follow PCE even more closely. It doesn't include food and energy. So it's to me, it's a fake number. But whatever the Feds need to get an excuse to cut rates, I don't think they're going to be cutting rates in the first half of this year. If anything, they may look at trying to do a cut in the July. Remember, after July, there is no August, and then you got one more September before presidential elections. And in general, the Feds don't like goosing the markets before a presidential election, but this political body is completely different. They are political in everything that they do. So let's see how they play this. Let's see how they react. And then finally, nat gas. I do like it to the upside. Nat gas came down much lower than expected because of some of the embargoes that Sippy Cup Joe has put on LNG exports. But I think that's going to probably come to an end before the end of this year. And then you're going to see nat gas come back up in a more reasonable over 2 to 2.20 up in this area here. You can see that big gap down. That gap will be filled probably, if not by the end of this year, early next year. It will be filled, I believe. The odds favor it being filled. All right, everybody, that's kind of where we're sitting right now on this short, brief update. Members, I will see you for our weekly market watch this Sunday at 7 p.m. If you're not a member, I highly encourage you to come in. We're having a good time. Should be a great year. And next year is going to be even more interesting as we go into a new presidential election cycle and a new term. All right, everybody, have a really great weekend. Ciao.